Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell, and I'd like to send you a special invite to come join us in Belize from February 15th till the 19th at the very first ever Palisade Real Asset Investor Conference. We're going to be speaking about hard assets and real estate, and we've secured keynote speaker David Cates, who's of course the CEO of Denison Mines and Uranium Participation Corp, to come speak. If you're interested, just send me an email, colin@palisadeglobal.com, and I'll be sure to get back to you. Now, today we're speaking with David Skarica, returning guest. He's the publisher of addictedtoprofits.net. David, thanks for coming back and joining us.
Good. Thanks for having me, Colin.
Yeah, lots to talk about since we had you on a couple months ago. The gold sector, particularly yesterday, which was Thursday, January 5th, had quite a day. The gold stocks were up. JNUG was up, I think, 30%. So I want to start by talking about gold. What do you see in the sector? Where do you see things going?
Well, I think the last time we spoke, I mentioned that I had sold some in the summer, then some again after the election, when it was obvious that there was going to be this rally in the dollar and probably a decline in gold and gold stocks. So what occurred though is I also mentioned in that interview, I remember saying that, look, at the November-December time period is usually the area where gold stocks bottom. And I sold I had a short position as a hedge to my gold stocks. And I sold that in December, and I've just recently, in the last few days, started buying a little bit again. They broke a short-term resistance level, gold and gold stocks, and I think they're probably maybe at least setting up for a rally. If you go look at the gold and gold stocks, they have a very defined downtrend going back to the summer, and if they break this downtrend line, they're right at it right now. We will probably see another move higher in the gold and gold stocks. And what's interesting, even though it's bouncing a bit today, the dollar actually has kind of fallen a bit. And a lot of the commodity-based currencies like the Canadian dollar or the Aussie dollar have rallied in recent days. Again, I don't know if this is just a bounce or something more, but we are kind of seeing these kind of inflationary kind of assets starting to do well. The base metals are doing well, and gold and silver, propped up. So I don't know how quickly this will go back to 1,300 or something, but I do think we're showing signs, especially in the stocks, of bottoming and potentially moving higher in the second half of the year.
David, that's great to hear, and we've also seen quite a bit of activity coming back into the uranium space, which is an area that we've been quite vocal about the last couple months. Yesterday, once again, was a pretty interesting day for the uranium stocks. On average, I think the big ones were up something like 6 or 7%, and for a portfolio of microcap or junior uranium companies, you might have seen gains of 20, 30, or 40% yesterday. I know that you saw the last uranium bull market unfold. Do you have any comments on the sector?
Well, I think I actually bought a lot of oil and gas stuff in November, and that's done really well too. I think uranium is going to be number one. It does have its own unique supply-demand situation where what happened with uranium, there was like a mini bubble in these stocks, which blew up. And then after Fukushima in Japan, there was a bit of a reaction back against nuclear power because obviously you had a meltdown at that power plant. But the problem is Japan has even themselves discovered, Japan is a country that has no natural resources essentially, so they have to either import natural gas or coal or whatever to produce power, or uranium. So Japan has reverted back to realizing they need nuclear power, and you've kind of seen the negativity after that disaster cool off, and the stocks became really, really cheap and really depressed. Now, I think somewhat it will be dependent a bit on the price of oil. You might say, Dave, what does oil have to do with uranium? Because the thing is, all these alternative energies, anything from clean power, wind, solar, to uranium, really depend on oil, because oil and natural gas still are the cheapest ways of producing energy. So if those prices go up, it makes all these other things more competitive, and the prices of them go up. So I think uranium that's the two things behind it. Number one, it does have its own unique demand situation, and it looks like demand is going to pick up. China is also building a lot of nuclear power plants. And I think number two will be, what continues to happen in oil and gas. And we've seen this kind of rally in oil and gas because OPEC cutting production. But if you just look at the charts of these uranium stocks, like some of these smaller stocks, they did have really, really nice bases. They're really, really beat up. It looks at the very least, I think the long-term kind of secular bottom in these stocks are up. And you're looking at stocks that a lot of them were, $20 stocks back in 2012 or 11 or something that are $1 stocks now. And that actually is the kind of thing I like to do. And I'm actually doing it in certain other stocks and sectors as well. Is you really, I think with an uranium stock right now, you could probably buy one and forget about trading, forget about it for 5 years, go to the beach, and probably 5 years from now, it's going to be a lot higher in price.
David, how many times have you told yourself to buy something and hold it for 5 years? Certainly not easy, but I would certainly agree with you on the uranium stocks.
Well, you actually mentioned that you're the CEO of Denison speaking at your conference, and Denison has a fantastic chart, a big base between 50 and 80 cents, and right now getting to the higher end of that chart. And if it breaks that, that's a classic. It's called a box. A guy named Darvis wrote this book about it way back in the 50s and 60s. And it's a classic box base, and it would probably go significantly higher if that 80 to 85 cents area is broken to the upside. I have no position, but I'm just telling you, just looking at the chart.
Excellent. David, let's move on to the general markets. I know that you have a lot of fear that at some point the markets are going to sell off. Now that Trump got elected, we've had this rally pushing up to 20,000 on the Dow. And not only are we afraid that maybe the Dow is going to come down, I know you've got yourself and your readership positioned for shorts in the event that it does. But what's your worry on, say, stocks like gold and uranium, that if you have a sell-off in the Dow, are we going to get a repeat of 2008 where the liquidity-driven selling to get into the dollar could actually not just crash the Dow, but could crash these commodity stocks?
I actually think the setup is more similar to 2000, 2002, where you had a multi-year bear market in these resource stocks, and that includes uranium and gold. And then they actually, they couldn't really start a major bull market until the market topped out in 2000. And then they actually went up while the bear market was ensuing in 2001 and 2002. Now, when you had the really intense selling pressure, like, for example, in the summer of 2002, what happened was the gold stocks got kind of taken down with everything else. So that's kind of more what I would expect, is that if the market starts to weaken and roll over and you see people's mindset change to, the Federal Reserve is going to be tightening monetary policy, to one of, not only they're not going to tighten, they might have to loosen again. They might have to do QE again. Gold benefits from that. Now, we're a ways away from that, right? But when that mindset changes, that will be good. And then probably if you get extreme bouts of selling, which you get in bear markets, they'll be taken down during those extreme bouts. But I would think they will actually now trade counter to the market, when that occurs. But the only thing I'm worried about is with the U.S. dollar having been strong, with the potential for a big debt crisis coming overseas from a place like China, that could be one more short-term deflationary bout, because obviously China still imports most of the commodities in the world, and if China has to devalue their currency and has to recapitalize their banking system, which basically means moving the debt of the banks from the banks onto the government balance sheet, similar to what happened in the United States in 2008, that could give commodities one kind of last whacking and cause a short-term deflationary bout, which would be a great buying opportunity. But that would kind of be my worry. But more than likely, I think probably the commodities will have rallied into that, and you'll just be taking back part of the gains if that kind of occurs. So I really think that it's more like 2001, 2002 in a nutshell, that they're probably going to trade higher while the market trades lower, as long as the market's just kind of grinding lower. But when you get these bouts of selling pressures and capitulations, they'll probably get whacked and taken down in the short-term bouts of extreme selling. And go look at gold stocks in 2002. That was the exact classic example. They rallied all year into July, and then when the market really tanked intensely for a couple of weeks in July, the HUI sold off, like 30, 40%. Now, granted, the HUI at that point was already up hundreds of percent from its lows. But, that could happen. But I think it's going to be more like 2002 than 2008.
I know you spend a good amount of your time following sentiment indicators and studying historical charts and try to compare them to the situation that we're in now. With the Dow at 20,000, objectively, it's never been anywhere close to this high. But how overvalued are things? Why can't things keep going higher? You feel that the timing is getting closer and closer to where we are going to have a sell-off. What's telling you that?
Well, we have these long-term indicators. They've been overvalued for since 2014. And that can happen, by the way. In 1998 or so, stocks became very overvalued and stayed overvalued till 2000. That's like market cap to GDP, stuff like that. But I think now we're reaching an extreme where, like, I watch indicators that show where hedge funds are putting their money, where sentiment indicators of people are bullish or bearish in the market, where individual investors are putting their money. They're all hitting extreme levels. Now, that doesn't mean that the market's going to decline tomorrow, but what that can often mean is you're going to start like some sort of topping process. So I kind of think we're going to break 20,000. It's a psychological level. We're looking strong in the first week of the year here. So we could break 20,000. That might even cause more excuse me, of a blow off to occur. And if that occurs, that would be probably something to sell into. So there's a way you can like position yourself with it. You can be an all out bear or just go to cash, or what you can do is and this is what I'm doing. You can be aggressive. A lot of these beat up type companies I like. I have pretty good sized positions in them, but I have large hedge positions. I own large positions in the bear ETFs. I have put options on companies, and you're kind of insuring yourself against a gain. That means you're not going to make as much money on the upside, but it means when everything tanks, you're not going to lose that much money. You might even end up making money. If you go look at guys like Kyle Bass in 2008, he was actually net long the stock market, but what happened was, he had or 2007, he had that CDS trade where, he was short subprime mortgages, and that blew up and made him all this money. And really that's kind of what I'm looking at, is that I have enough of a short that everything does blow up. I think net I'll end up making money, but if it doesn't, I have long exposure that will probably make me money as well. Nothing's perfect, and that's not a guarantee, but that's the way I'm playing it right now. And I kind of changed after Trump won because I thought there would be this enthusiasm in the stock market. So I went from being kind of defensive to being more aggressive with a hedge position. Now, it's tough for the average person to do, but I think sometimes you have to think about how much money you can lose rather than how much money you can make. And, that was the mistake I actually made myself in 2008. I wasn't hedged enough. So, I learned from that. So, yeah, I think that's kind of what I'm looking at right now. Shorting some of these overvalued stocks, shorting the market on mass, and going long some of these kind of beaten up stocks. I don't chase, by the way. Like I'll just give you an example. I bought an oil and gas company called Athabasca. I don't obviously recommend it now because it's had a run. This is a company in the oil sands in Canada. And I bought that around 130 to 135 in the newsletter. It's trading at $2 right now, and the stock used to be a $20 stock. So I buy beat up things like that, and I have anything ranging from a video game company to a healthcare company to mining companies that are these kind of beaten up companies right now.
David, a serious plot twist in the narrative of most analysts from, say, 1 year ago is the performance of the industrial commodities. Everybody was expecting the precious metals to take off first, and in a way they did, but we've seen this incredible performance in a lot of the industrial commodities. I know vanadium is up 80%, copper's up in the double digits, iron ore's up 50 or 60% off of the bottom. Do you expect this trend to continue, and how would the market coming back, a market crash, affect it?
I'm a little mixed on the industrial commodities because I believe a lot of this was due to this belief. And if you go look at COPX, this is an ETF that's copper miners in the United States. And if you go look at it, right after the election, huge volumes came into this on the breakout. The thing went from about 17 to as high as 23. It's about 21, 22 as we're speaking now. And I think the problem is, I think a lot of this is perception rather than reality with the infrastructure program. First of all, the infrastructure thing is going to be the toughest thing for Trump to put through. The Republicans don't mind cutting taxes. We know that. They don't mind doing defense spending. We know that. But they don't want to do infrastructure spending. That's one thing they do not really are not gung-ho about. And that might be something he may have to put off or really make smaller to kind of agree with them. And I made the statement, I think, on your last show that he's looking at $1 trillion over 10 years. I think he's even cut that to like $500 billion now. And we're talking 50 to 100 billion a year. And China, okay, they spend that like in a week or two on infrastructure. So China is still the driving force for these industrial metals. Now, I'm not going to talk about the EDMs, the kind of rare earth type metals, because they have unique uses, especially in clean energy and catalytic converters, all this sort of thing, right? Lithium ion in your phone battery or whatever. But definitely the base metals, especially iron ore, I would be really wary of right now, because iron ore, there is a huge, gigantic supply glut, and that has not been worked through. So unless we get a kind of inflationary a deal going on, I don't think we're there yet. I think we need the Federal Reserve printing money to get an inflationary trade in the base metals. I'd be really cautious here. And actually, the caution tale is, even though you may say, hey, this has nothing to do with commodities, if you go look at a lot of these shipping stocks, they pumped and dumped after the election. The idea was that Trump's going to this is going to cause a boom in the economy, and the shippers are going to be moving more material. And a lot of these stocks just went up hundreds of percent and then came right back down. And I do wonder if we're seeing a less intense, slower motion version of that in some of the base metals. So they've had a good run, but I'd much rather buy, you're talking about uranium or gold and precious metals. I'd much rather buy them right now.
Well, finishing off here, David, let's touch on the 2017 rebalancing of the portfolio. You write a newsletter and you have a very large following. Things change. You get new inputs. Certainly, things look a lot different than they did at the beginning of 2016. What's kind of the general way that you're going to weight things over the next few months?
Well, what I always do is, I always rebalance. So even when I do is like, let's say a couple of these beaten up stocks, like I mentioned, Athabasca, something like that, do well. What I'll usually do is take some profits and then put that into maybe even a bearish instrument to kind of rebalance my bearish side. Or, for example, I just bought some precious metal stocks. I sold into the spike, and now, in the summer, and now they're lower. So I was looking at averaging down on the positions I have left. So, yeah, I think like over the first 6 months of the year, I think definitely looking at precious metals would be a way to go. If you do want to hedge, my newsletter, we kind of specialize trading some of these bear market kind of ETFs. I think you still can't get complacent with the market this high. Actually, in a way, it's more dangerous now than it was, a year or two ago. I think the one thing we were missing, even though I've been bearish for quite a while, we were missing kind of this enthusiasm and this kind of optimism. And I think now we're seeing that with this election of Trump and this blow off that's happened recently. And so I'd look at rebalancing there. And yeah, I would just keep some of the other positions that you have, or whatever they may be. Like if you're already in the uranium stocks, you're already in a lot of these things. I think you can't time. See, the one mistake I've made, and I'll be honest with my mistakes, is I've been so worried about a stock market crash the last 2 years. A lot of the times I've sold out too early on the beaten up stocks I bought. Like I bought an iron ore stock called Cliffs Natural Resources at like $1.50 a share. Okay. And this stock went all the way to $10 a share, but I sold out between $3 and like $5 a share because I was so worried. This was last spring. It started to spike. I was like, no, there's going to be a crash. Like this is going to go right back to 2. And you can't do that. So if you have a beaten up stock and it's cheap, I would just hold those positions. And rather than selling, like I said, hedge. Hedging is really the key. People don't do it. That's why most people get killed in bear markets. But with the market so overvalued right now, I think it's really important to hedge. And like I said, just and that way you don't have to sell the stock that you want to own, right? If you like uranium, if you like gold or precious metals, if you like even the base metals, even though I'm not that bullish on them, if you like them, then you can just you can hedge rather than have to sell it and then miss out on a big gain or something like that.
Right on. Well, David, thank you so much for coming back on the program. For all of our listeners, David's website is addictedtoprofits.net. David has a free list that he sends information out to, you can sign up for, and of course premium content if you'd like to go that route. David, anything else to add for our audience?
No, just like I said, actually last thing I was to say, the stocks I'm buying too, I'm a little different. I'm buying super beat up stuff. So that's why I also don't get, don't get so worried about a market decline, because a lot of these stocks I buy are down 80% and a market at all-time highs. So I don't see a 10 or 20% correction really hitting these things. Like, the upside didn't hit them, the downside is probably not going to hit them. So that's another thing too. If you're owning stuff that's cheap, you probably don't have to be as worried about a big market decline.
David, thanks for coming back on the program.
Thanks.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?